the market is up. Everyone knows that. And people finally have equity in their properties again. So the biggest question, especially on investment properties, is capital gains taxes. So Ted is the professional. He's here to talk with us about what capital gains are and if they're going to affect you. Capital gains. What type of properties are subject to capital gains?
Well, pretty much any property is subject to capital gains, but you do have exemptions on a primary residence, and I want to mention that really quickly before we get into the investment category of properties. Most people sell their homes, their primary residence, and they are typically not subject to capital gains. There's a $250,000 exemption from your profit, and up for per person, and up to $500,000 for a married couple, on the profits that they make on the sale of their home. And this is a pretty common question that we get at a closing when a seller is exposed to, is going to walk away with some money, and they're concerned that they might have exposure to capital gains. So, if they're selling your primary residence, and there's a couple little categories that they need to watch out for. It has to be their primary residence for at least 2 out of 5 years. The residence can't be used for a business purpose, and they didn't sell or exchange another primary residence in the last 2 years. But if that's the case, and they fall within that parameter, then their profits are not taxable. Yeah.
If somebody has an investment property, okay, let's say they bought the property for $200,000, and they're turning around and selling it for $250,000.
Okay.
After all of their closing costs, which would be commission, tax stamps, repair costs for
holding
for
costs,
the inspection.
Yep.
After all of that, let's just say they have $25,000 left over. Mm-hmm. Is that $25,000 the only part that's subject to the capital gains? And if so, is there any way to reduce that liability?
I do believe that that not the full $250,000. Obviously, is taxable. It's the difference between what you've mentioned, which would result in about let's say a $15,000 in our hypothetical exposure to that tax, and that tax is also dependent upon the length of ownership, whether or not it's a short-term, long-term capital gains, and your tax bracket. How much you earn, and all these factors come into play to determine what your tax consequence is. So, Emilio, it's really a convoluted process. You do want to contact an accountant or CPA, but I'm definitely here to help, and you can reach me at 401-533-9888. That's 401-533-9888.